Wake up! Not because the chart moved, not because your feed is screaming 103, but because something bigger just happened behind the curtain. As of January 26, 2026, silver has shattered the triple-digit wall and printed roughly $100 to $103 an ounce. That's the headline. The story is the plumbing. Because when a market goes from paper to physical, the rules change. And when the rules change, the winners are not the loudest people online. The winners are the quiet institutions that already positioned themselves before the crowd understood what was happening. Today's topic is simple, and it's a final warning. JP Morgan just took control of the silver market. Now listen, this is not a courtroom claim. This is not an accusation. This is a market narrative built on public vault data, analyst reconstructions, positioning shifts, and a decade of strange behavior that finally makes sense if you assume one thing. The biggest players stopped fighting silver and started owning it. If that sounds dramatic, good. Because the silver market right now is dramatic. For years, the popular story was banks suppress silver. The villain was simple: massive short positions, endless paper contracts, price caps that made no sense against real demand. But stories evolve. And in late 2025 into January 2026, the narrative mutated from suppression to strategic dominance. Here's the pivot rumor that matters. The bank that was criticized for being the heavyweight short allegedly closed those historic shorts, then flipped net long. And not long on paper. Long where it counts, bars, not bets. The number that keeps circulating is huge. Roughly 750 million ounces of physical silver amassed over years. That's about a full year of global mine supply. Let that sink in. If that estimate is even directionally right, it means one institution holds a pile large enough to tilt a market that is already thin, already stressed, already short on deliverable metal. And here's the detail that should make your skin go cold. Analyst reconstructions suggest that by January 2026, this physical position could be more than 25 times the silver sitting in COMEX registered vaults, the category that is supposed to be deliverable. That doesn't mean they own COMEX. It means something more subtle. It means if the world suddenly demands delivery, the public pile is tiny, and the private pile becomes power. How control really works. Let's be honest. Control sounds like a conspiracy word, so let's define it like a mechanic, not a poet. In a commodity market, control is not a magic button. Control is the ability to do three things: survive a delivery run when others can't, set the terms of scarcity, lease rates, availability, and timing, profit from volatility while everyone else argues about price targets. Think of the silver market like a small town with one fuel depot. For years, everyone traded paper coupons for gasoline. The depot didn't mind because almost nobody actually showed up with a truck. But now, suddenly, trucks are lining up. Real trucks. Real tanks, and the depot has to deliver. In that moment, the person who quietly bought real fuel months ago becomes the person who sets the price of survival. That's what control means here, not they decide the price every day, but they can endure the shortage and monetize it. The physical hoard question without the fairy tales. Now, about that 750 million ounce figure. You will hear it said like gospel. You will also hear it mocked like fantasy. So here's the responsible way to treat it. As a working hypothesis, not a holy number. The point is not whether the pile is exactly 750,000 ounces. The point is whether a single institution has accumulated a position so large that it changes behavior across the entire ecosystem. And you can feel that behavioral change without ever touching the exact number. Because when a big holder exists, three things start to happen. The market gets stiffer. Big dips get bought faster than they used to. Lease rates and tightness show up even when price looks calm. Delivery stress becomes chronic, not occasional. In other words, the footprint matters more than the headline. If you want to think like a pro, you ask two questions. Who is the marginal seller of deliverable metal right now? What happens if that seller stops selling? If the answer is the marginal seller is exhausted, then the next price move doesn't come from hope. It comes from necessity. And necessity doesn't negotiate. Registered versus eligible, the words that decide reality. Most people talk about COMEX inventory like it's one bucket. It isn't. There's a difference between metal that exists in a vault and metal that is tagged, warrant ready, and available for delivery. That's the difference between eligible and registered. Eligible. It's in the building, but it's not committed to satisfy contracts. It's like a car in a garage that is not for sale. Registered. It is tagged for delivery. It's like a car with the keys on the hood and a signed title. When panic hits, eligible can stay eligible. It doesn't magically volunteer itself. So when people say registered inventory is at multi-decade lows, they're saying the for sale pile is shrinking. And that is why the claim 25 times registered is so important as a signal, even if the precise multiple shifts. Because if one holder has far more metal than the deliverable pool, then deliverability becomes a bargaining chip, not a given. How banks profit from scarcity without pushing a button. Here's what institutions can do with a physical position that retail can't. They can lease metal into the market when it is needed most, collecting high lease rates. They can choose when to release inventory, smoothing their own risk. They can collateralize the metal, turning it into funding power. They can serve industrial clients who must secure supply, building long-term relationships. They can hedge volatility in layers because they have the underlying asset. This is why the narrative they stopped suppressing and started dominating is believable as a survival strategy. Because once silver becomes scarce, the most valuable thing is not predicting the next candle. It's being the person who can say, yes, we can deliver. That sentence is worth more than 1,000 tweets. Picture an industrial procurement manager on a Monday morning. No drama, no conspiracy, just pressure. Their phone buzzes. A supplier says delivery is delayed. A second supplier says premiums are rising. A third supplier offers inventory if they sign a longer contract today. And that manager doesn't care about your favorite influencer. They care about one thing. If we don't get silver, a line stops. When a line stops, penalties trigger. Customers get angry. Contracts get renegotiated. Jobs get blamed. Budgets get cut. That is why industrial demand doesn't behave like an investor. It behaves like oxygen. Investors ask, is it cheap? Industry asks, is it available? And when industry starts asking louder, price becomes secondary. The perfect storm of January 2026. So why did this explode now? Because January 2026 stacked catalysts like dry wood under a match. Catalyst 1, export licensing shock. On January 1, 2026, strict new export licensing rules were enforced by the world's dominant silver refining hub. Whether you call it a policy or a rule change, the effect is simple. Western supply lines tightened. And when supply tightens in a market this small, the price doesn't politely adjust. It lurches. Catalyst 2. Industrial desperation. Silver is not a luxury metal. It's a critical input. AI data centers, solar, EVs, power electronics, medical uses, advanced soldering, high-efficiency contacts. Silver isn't optional in these systems. It's functional, and unlike many metals, substitution is limited without performance loss. Catalyst 3, the delivery psychology shift. Mid-January, reports point to roughly 26% of COMEX registered inventory being withdrawn in a single week, and that is the loudest signal of all, because it says, people stopped playing for cash settlement. They started playing for bars. A cash-settled market can fake abundance. A delivery demand market cannot. What a delivery crisis looks like in real life. People hear delivery crisis and imagine a single dramatic day. In reality, it's a sequence. Phase 1. The quiet drain. Registered inventory bleeds out week after week. The headlines ignore it because price might still be range-bound. Phase 2. The paper squeeze. Open interest stays high while deliverable supply shrinks. Suddenly, the ratio of promises to metal becomes embarrassing. This is where lease rates begin to lift, because borrowing metal becomes harder. Phase 3. The trust event. A moment arrives when a big holder says no, not with words, with behavior. They stop selling inventory at paper terms. They demand better premiums, better clauses, better timing, and the market feels it as a snap in the rope. Now, does that mean default? Not necessarily. Markets can avoid default by changing rules, incentivizing cash settlement, or inventing new settlement pathways. But that's the point. When a market must invent settlement pathways, it is admitting scarcity. Why lease rates? Spike, the best hidden indicator. Lease rates sound boring. They're not. They are the price of permission. If you are short silver and need metal to meet a commitment, you can do two things. Buy it outright or borrow it temporarily. Lease it. Then return it later. When metal is plentiful, leasing is cheap. When metal is scarce, leasing becomes expensive because every lender fears they won't easily get it back. That's why reported lease rates moving from 1% toward 8% to even 30% is a flashing red light. It says metal is being treated like a strategic resource, not a casual commodity. And it also says something else. Someone with metal can name their price. The paper game in 1 minute. To understand the pivot narrative, you must understand the game banks were playing. For years, the silver price was heavily influenced by paper contracts. Futures, options, unallocated accounts, claims on silver, not silver itself. In that world, you could sell a lot of paper without touching a single bar, as long as most participants were speculating, cash settlement was socially acceptable, and delivery demand stayed low. That structure can suppress volatility. It can cap rallies. It can create the illusion of endless supply. But it has a fatal weakness. When enough participants demand delivery at the same time, paper is forced to confront atoms, and atoms are not infinite. Why $100 matters more than people think. Yes, $100 is psychological, but psychology changes flows. Above $100, three groups wake up at once: momentum funds that buy strength, industrial buyers that panic about supply continuity, the public that suddenly treats silver as serious. Those flows collide in a market that is small, so the move from 99 to 103 is not just $4. It can be a trigger that pulls future demand into the present. When that happens, a shortage becomes self-accelerating. The gold-silver ratio as a stress gauge. Let's talk about the gold-silver ratio, GSR, because it's more than a trivia stat. When the ratio is high, 81-91, it often reflects that silver is being treated like a sidekick. When the ratio compresses, 61-51, lower, it can signal that silver is becoming the main character. And why would silver become the main character? Because gold is mostly monetary. Silver is monetary and industrial. So when industrial urgency arrives, silver can lead. A ratio near a 50.1 in this environment is not just silver outperforming. It is silver under stress. What it means if one player is the biggest holder. If a single institution truly holds an outsized share of readily deliverable physical silver, it changes the balance of power. It changes who can meet urgent demand. It changes who can lend metal into tightness. It changes who can wait out volatility. It changes who can starve the market without making a speech. Again, this isn't about cartoons. It's about inventory power. Because in commodities, inventory is a vote, and the biggest inventory holder has the loudest vote. The wealth transfer mechanic, explained like you're 5. People throw around wealth transfer like it's a slogan. Here's how it happens mechanically. Step 1, paper claims get repriced downward relative to physical reality. Step 2, physical owners gain pricing power because they can deliver what paper only promises. Step 3, the spread between spot and real widens. Premiums rise. Step 4, institutions reallocate into what survives scarcity. Step 5, the public arrives late and pays the scarcity tax. In other words, the wealth transfer is often not just price going up, it's availability being rationed. And the people who own the atoms get the better deal. Educational disclaimer, because this matters. Quick reminder, this video is educational and narrative-driven. It is not personal financial advice. Markets are volatile. Commodity moves can be brutal. Your risk is your responsibility. Now, back to the story. The numbers that show a regime change. Let's line up the before and after, because regime change always leaves footprints. In 2024, silver lived in a different world. Price, roughly $24 to $28. Gold-silver ratio, around 80.1. COMEX registered inventory, around 40 million ounces. Lease rates, around upper 1%. Now look at January 2026. Silver price, about 129 to 103, or gold-silver ratio, near 50.1, meaning silver is outperforming. Registered inventory, multi-decade lows. Lease rates reported anywhere from about 8% to 30%. Lease rates tell you what the street knows. If you can borrow silver for 1%, it means nobody is desperate. If you have to pay 8%, 15%, 30%, it means the metal is scarce, valuable, and being rationed. That's not normal. That's not a healthy market. That's a market screaming, there is not enough. Why the bank pivot makes cold sense. Now, if you're an institution and you see this storm forming, what do? You stop being the person selling promises, and you become the person holding inventory. Because the paper game only works when people accept cash settlement, inventories look stable, and the public believes price is the whole story. But when industrial users must secure feedstock, when the public demands delivery, when inventory drains, paper becomes a liability. So the survival logic is brutal. If you keep shorting into a physical shortage, eventually someone calls your bluff. And when your bluff is called, you don't lose a trade. You lose credibility, relationships, and access. The smart move is to reverse the posture. Stop betting against silver. Start becoming silver, not as a trade, as a strategic asset. Because in a shortage, inventory becomes leverage, and leverage becomes dominance. The final warning and what it really means. So why call this a final warning? Because the warning isn't, silver will go up tomorrow. The warning is, the structure is changing, and the window to understand the rules is closing. Here are the 3 structural shifts that define the warning. Shift 1. Price discovery is drifting from paper to physical. For years, New York and London paper flows told the world what silver was worth. But if deliverable inventories are drained, paper loses authority. The physical market starts dictating terms, availability, premiums, delivery times. Shift 2. The incentive to cap price disappears when banks are long. Here's the brutal truth of incentives. If a big institution is net short, lower prices help them. If they are net long and physically stocked, higher prices help them. So when the positioning flips, the behavior flips. Analysts like Keith Neumeyer and Robert Kiyosaki have long argued that once $100 breaks and major banks are positioned long, the institutional incentive to smash price back down weakens. Shift 3. A wealth transfer can happen faster than people expect. If silver moves into the $125 to $175 range, as some 2026 forecasts suggest, this isn't just a nice bull run. It's a repricing event, a transfer from paper comfort to commodity reality. And remember, silver is small. A small market reprices violently. The part nobody wants to say out loud. Here's the uncomfortable line. If the physical hoard estimate is even partially true, then the crowd is late to a game that was decided years ago. That doesn't mean you can't participate. It means you must stop thinking like a day trader and start thinking like a supply chain. Because the winners in a physical squeeze are not the people who guess tops and bottoms. They're the people who secure availability before scarcity becomes public panic. And if you're still framing this as, will it hit $110 or dip to $97, you're staring at the wrong screen. The real question is, will physical silver remain freely available at anything close to paper price? The 3 doors that close after a regime change. When a market shifts from paper comfort to physical constraint, 3 doors quietly close. Door 1, the easy buy door. In normal times, you click and you receive. In tight times, you click and you wait. Or you click and the premium shocks you. Door 2, the fair price door. Paper price is a quote. Physical price is a negotiation. When supply is stressed, negotiation wins. Door 3, the clean exit door. In calm markets, you can sell or hedge with minimal friction. In stressed markets, spreads widen and liquidity becomes selective. The exits still exist, but they stop being equal for everyone. That is why the smartest people don't wait for perfect confirmation. They watch the doors. Why the bank long idea changes the entire movie. If banks are structurally long physical silver, then the old script, they must slam it, is no longer guaranteed. Instead, the new script looks like this. Allow price to rise because higher price attracts attention. Let attention pull in more demand. Use volatility to shake out weak hands. Meanwhile, use physical inventory to serve the highest value clients and extract premium. That's not moral, that's mechanical. And it is exactly how dominance looks when scarcity becomes an asset. The simple question to ask yourself tonight. Forget the internet noise and ask this. If silver is truly scarce, who benefits most? Not the person with the strongest opinion, not the person with the loudest thumbnail. The person with the biggest stack of deliverable metal and the patience to wait. That's why this story matters. Because if the control shift is real, then the breakout above $100 is not the climax, it's the reveal. A final warning checklist you can use without guessing prices. Here's a simple checklist for the next 30 days. No predictions, just observation. If spot rises while premiums rise faster, physical is leading. If spot falls but premiums don't, physical is refusing to follow paper. If registered inventory keeps draining, deliverability is tightening. If lease rates remain elevated, the street is paying up for metal. If large withdrawals cluster near delivery windows, stress is real, not theoretical. If dealers begin limiting quantities, rationing has started at the retail edge. You don't need a guru for that, you need eyes, because the market will tell you what it is if you watch the right things, what to watch in the real world. Let's get practical. No hype, just signals. If this is a control shift, it will show up here, premiums. Watch the difference between spot price and what real bars cost. When premiums rise while spot chops, it's a sign the paper quote is lagging reality. Delivery times. When dealers and industrial buyers start quoting delays, the shortage is operational, not theoretical. Lease rates. If lease rates stay elevated or spike again, it means the metal is being rationed. Registered inventory trends, not total inventory. Registered, because registered is what can actually be delivered. Cash settlement language. Any increase in incentives to settle for cash, or language that normalizes cash substitution, is a stress signal. The gold-silver ratio behavior. If the ratio continues to compress, it implies silver is leading, often because industrial urgency is pulling it, not just investment flows. The 2 lies that will wreck you. Lie. 1. If it was real, it would be on the news. Markets often reveal truth through spreads, not headlines. Lie 2, I'll wait until it's confirmed. By the time the crowd agrees, the premium is the confirmation. And you pay it. Stay calm, stay systematic. This is a thinking person's market now. The mental trap that gets people destroyed. There's a psychological trap here. When silver hits $100, most people feel two emotions at the same time. Excitement. I was right. Fear. I missed it. That combination makes people do dumb things. Chase candles, buy tops, panic on dips. But this is not a normal breakout. This is a regime shift. And regime shifts are not traded like a meme pump. They are navigated like a storm at sea. In storms, you don't worship the waves. You watch the compass. So don't obsess over the daily wiggles. Obsess over the structure. Inventory, leasing, premiums, delivery behavior, industrial language. One last image to burn into your mind. Imagine two rooms. Room 1 is a trading desk. Screens, quotes, contracts, arguments. In that room, people feel powerful because numbers move. Room 2 is a vault corridor. Pallets, seals, bar lists, forklifts, security doors. In that room, power is silent because it is physical. January 2026 is the month the market started walking from room 1 to room 2. And if the biggest institutions are already standing in the vault corridor, then the final warning is simply this. Don't confuse a price quote with control. Control lives where delivery happens. The cleanest way to think about JP Morgan in this story. Let's strip the emotion. No anger, no hero worship, no politics. If a large bank holds a massive pile of physical silver, that is not good or evil. It is strategic. It means they can provide metal when others can't, lend metal at high lease rates when scarcity bites, and then benefit from price repricing without being vulnerable to delivery runs. That is what taking control looks like in commodity terms. Not a secret meeting, not a cartoon villain, a balance sheet that survives the squeeze. If you believe this framework, then the next act of this story is not just higher price, it's tighter allocation. Here's the sequence that often follows. Breakout attracts attention. Attention attracts new demand. New demand hits thin inventory. Thin inventory forces rationing. Rationing lifts premiums and lease rates. Paper price tries to catch up, sometimes violently. And during that sequence, the strongest hands are the ones who already own the bars. So here's the final warning in plain language. Stop treating silver like a ticker. Start treating it like a strategic material because the market is signaling that the paper era is ending. And if the big players have flipped from short to long, the game board has been rotated. The breakout above $100 isn't the finish line, it's the starting gun. And when the starting gun fires, you don't want to be the person still asking, wait, where do I even get the metal? You want to be the person who already understood the rules. Remember, in scarcity, the question isn't what's the price, it's who gets the metal. Right now, if you made it this far, comment one word, delivery. If you think the physical market is now the real story, chart. If you think paper trading still controls everything. And if you want the next video, I'll break down the 3 plumbing metrics that tell you when a squeeze becomes irreversible. Premiums, lease rates, and registered inventory behavior. Stay sharp. This market doesn't warn twice.